But we still have work to do, and let's do it, right? So let's talk through this. I want to tell you what we're working through. Cooley is a law firm out in California, based in California, really an international law firm that has put together some self-help for entrepreneurs through a set of document generators. And I use these in various courses in various formats, and there are a number of documents on here. We're going to be looking at their incorporation package generator, and we're going to be answering a set of questions about a startup company, kind of creating this hypothetical company and generating these documents so that we can learn what they consist of. So anyone can access this. It's free. It's called Cooley Go. And this is going to generate, we're going to generate all the documents just so we can see them all. That action by the incorporator they talked about, the way that you could avoid having the directors listed on the initial certificate of incorporation by then having it action of incorporator. We're going to generate that document. The certificate of incorporation, which is going to be a little more complex than the one we talked about from sort of your basic form approach. It's going to have a couple of the provisions to protect directors in it. The bylaws, which are very long, so I'm not going to go through them all, but we are going to look at them a little bit. We have some hypotheticals next week and the week following. Oh, and by the way, an announcement about the rest of the class. So I was putting together slides for the next chapters, and I hit 50 slides before I even got to legal opinions, and I couldn't make it smaller than that. I think we need 3 weeks to go through that material. So since you've already taken the online modules on capital formation, I think we'll go at a pace to make sure everyone is comfortable. And we may, depending on how we do today, we may need to revisit some of this, right? So anyway, the bylaws are going to be an important document to review and understand because they're one of the sources of corporate authority. And we're going to learn about that authority next week and refer back to these documents. The employee confidential invention and information assignment agreement is something really particular to startups that have intellectual property. And so we're going to just address that very briefly. It's something that I talk about a lot more in my venture capital class as we talk about forming a real startup. It's really more of an intellectual property issue. That document there pertains to allocation of intellectual property rights. So we're not going to worry about that for this class, but we're going to generate it. The initial action by directors comes with three different names. They're all synonyms. So here it's called an initial action by directors or a unanimous written consent. I use the term organizational resolutions. It's the first sort of set of documents generated when a company is formed. The board has its first meeting and authorizes a number of important actions. So I do want to look at that particular document in some detail so that you're particularly familiar with the first steps that a company takes, because really that's part of the formation process, and you have to get into the document itself to see what are all those steps and things that are done. The restricted stock purchase agreement, again, is not something particular to this course, but the founders, as we've discussed, every corporation has to have at least one share of stock, and so that stock has to be issued in some way. This is the document that issues that stock. And it's typically issued with some features on it, stock restrictions that prevent it from being resold, and also it does something called vest over time. So let's say there are 1,000 shares. It'll typically vest over a 4-year period or monthly. So actually the numbers are easier if I do like 480 shares. So if it's 480 shares, every month you would get 10 of them until you have reached 480 shares over the course of 4 years, right? 12 months by a year times 4 years. They can also have features like a cliff, like you get the first 120 after 1 year, nothing before then if you leave. And the reason that we do that is so if a person joins a startup company and leaves early, we don't lose all of that stock, we get some of that back. So it's a way to incentivize them staying. Again, that's going to be beyond the scope of what we need to know for this class, but it's something I think important for you to see. And it's something that we do in the venture capital classes. We actually generate those agreements based on some forms. It also assigns technology and does a couple other things. So again, just sort of recap what's important here. The most important thing we're going to do today is generate that certificate of incorporation, and you'll see that it has all the formal requirements that we talked about. There are really only 5 requirements in a certificate of incorporation. There are a lot of optional additional features. And so we'll see what those are and also get kind of a tangible approach to what we file, and that's the public document. Generating the bylaws is important. We're going to take a look briefly at how those bylaws provide authority when we do that next week and the weeks following when we talk about authority. The authority can come from the bylaws. That's an express grant of authority that we'll learn. So we're going to come back to those in the future. And really important for today is that initial action by directors, because that's going to show those formation steps the company has to take, the things we talked about last week, like creating a bank account and registering with the IRS and matters like that. The restricted stock purchase agreement and the EACA, the Employee Confidential Information Assignment Agreement, set aside for now. And the action by sole incorporator, you'll see, is very simple, but is an important step to avoid having to disclose the directors on the certificate of incorporation. Any general questions about sort of just the nature of what we're going to cover today, what we're going to see? So let's actually do it. So you can use this Cooley document generator to actually generate these documents. I assure you I have, in fact, read these terms of use before, so I'm going to go ahead and agree to them. They're essentially saying that, the information is non-confidential and anything that we do here is not legal advice, which is fine. We're lawyers, so we can use these sort of services. But so at the onset, we have this sort of interesting fundamental question, type of corporation, and it gives us two choices, a C corporation or a public benefit corporation. So my first question is, what's the difference between a C corporation and a public benefit corporation? If we check the box public benefit corporation, what does that change from a technical standpoint? And what does that change from an operational standpoint, a more global general standpoint? Now the technical answer you won't know just offhand. I have a set of documents that shows a red line version of the changes, so you'll see that later. But does anyone know what a public benefit, what is the difference between a public benefit corporation and a normal C corporation? Yeah.
Isn't B Corp out to give back to the community and make global impact at some point or national impact? So therefore something that's pro society, and C Corps can be just basically to make money. B Corp is to give something back.
Exactly. The purpose of a B Corp or a public benefit corporation is to have some contribution to society. So how would that flow into these formative documents? How would being a B Corp change your documents? What about having an obligation or the ability to benefit society would be incorporated into the documents themselves?
That would probably be written as part of their purpose statement, on the certificate of incorporation.
So we could limit their purpose to having a social purpose, right? But we've also learned that limiting the purpose can create legal liability. So if we limit the purpose to only a social purpose, right, and then we could therefore be sued for engaging in another business purpose which is not social. So we're actually not going to change the purpose statement because we're going to try to keep the purpose broad. We're going to have the ability to engage in a social purpose, but we don't want to limit the purpose to just that because people could define that differently.
Couldn't they just add it to the purpose of shareholder wealth maximization?
So usually the purpose is any lawful purpose, which is meant to be written to be as broad as possible. So what I teach in contracts is anytime you kind of create a list or try to add anything, you do run the risk of limiting the ambit of what's covered in that list. So your effort might be to talk about everything under the sun, but if you want to say everything under the sun, you should just say that. You should just say everything. And so there's nothing broader than any lawful purpose. That's the broadest statement possible. Anything in addition to that would either have no effect or limit the purpose.
Got it.
Yeah. So we won't actually change the purpose statement, but that's right. We are changing the purpose. What else might we change, though? Yeah.
Is it limiting where profits will go and stockholder dividends and things like that? Is where
we're getting much closer here, right? So we're not going to necessarily limit profits, but what we might do here, and what happens when you check this box, is we allow we basically allow the directors to make actions for the benefit of society. So directors are obligated to act in the benefit of shareholders. And the default is that directors have an obligation to maximize shareholder wealth. Shareholder wealth maximization is the default state of the law. And so by checking this public benefit corporation, we basically are going to add provisions throughout the bylaws and certificate and other places that say the shareholders cannot sue the directors for engaging in social responsibility. So, for example, with Ford, if Henry Ford had created a public benefit corporation, the Dodge brothers would have had a harder time suing him when he said, I'm going to make cars cheaper because it's beneficial to society. The Dodge brothers were able to sue Henry Ford because Henry Ford said, screw the shareholders. They don't need more money. I'm going to divert money from the shareholders to society. And that's not lawful unless otherwise provided for in the documents. By checking this box, and I will post a red line that shows these changes, the bylaws, which are effectively a contract between the shareholders and the management, say the management, the directors, are expressly permitted to engage in corporate social responsibility. And so they don't have to come up with this rigmarole where they pretend it's for profits. So we're not going to form a corporation like that today, but I will post online a red line, which I've created. I created one set of documents with the C Corp and one with the Benefit Corp, and I ran a red line. You guys all know what a red line is? A red line is you know what track changes is in Microsoft Word? So a red line is going to show those changes. And it's a technical term. It used to be harder to do, and I remember at the firm I had a program called Delta View Comparison. You can now do it right in Microsoft Word. You can go click Review and hit Compare Documents. You pick two documents, and it will show, like in track changes, what's different. So I've generated that, and I will post that, and you will see what happens when you click this button is it adds various provisions that all pertain to enabling the directors to act for the benefit of society and preclude the shareholders from suing them for doing so. So when would a corporation want to do that? Well, I mean, shareholders now are effectively limiting their ability to sue the directors. And we will see as we go through really next semester in much more detail. But it's a real open question as to whether shareholders want to be able to sue directors or not. Shareholders don't necessarily want to be able to sue directors because sometimes there's like 1 million or like more than 1 million shareholders. And if any one of them can sue the directors, that means that the directors have to be watching their back all the time. And they might be very cautious. Whereas if a corporation has a lot more laterality, if directors are not afraid of being sued, they might be taking more risk. And some corporations are better off taking certain risks. Moreover, if the purpose really is social benefit, you don't want directors that are worried that by engaging in this type of benefit activity, they're personally going to be sued for that. So these sort of provisions are going to do that. Anyway, we're not going to generate that today because we're going to focus on the C Corporation. And by the way, we're going to see how we're going to make an S election on that C Corporation later. But that's the fundamental difference there. Does that make sense? By checking that box, we effectively give the directors more power. We give them more freedom, and we preclude, they're opposites, in effect. The more freedom the directors have, the less the shareholders can sue, right? That's the boundary, because the director's liability and the shareholders' ability to sue are really two sides of one coin. As we give the directors more freedom to engage in certain activities, we preclude the ability of shareholders to sue for those abilities. And it's an open question. I mean, there are some jurisdictions where shareholders have more rights, some where they have less rights, kind of a broader conversation. This would give shareholders less rights and directors more rights to engage in social benefits. This one's an easier one. We're just going to generate all the documents. We can throw away the ones we don't need. It means we have to answer a couple extra questions, but that's okay. We're going to learn a couple things along the way by answering those questions. Did you read the instructions? Yes, I did. Fine. All right, couple drafting tips along the way. So this seems like a really straightforward question. What do you want the date to be? But actually, I don't think that even this is so simple. Because when you generate a lot of documents, one thing you want to do is be able to modify them very quickly. This is a practice tip. This isn't a law. This isn't law per se. But if you generate a lot of documents, pretty much what you want to be able to do is to change everything quickly and accurately. So it helps if there is a similar date and you can basically hit Control F and replace. If you can hit Control F replace and go through a document and get the right date plugged in there, you can do that in one step with no errors. So it may seem intuitive that you might put like today's date, but you might also just put a totally crazy date that is easy to find in the document later. And that way, when you hit Control F and you enter that date, so you could put you put, I don't know, March 10, 2200, right? 2020, 2220. And that way you can just Control F for that exact phrase and change it to the date you want, and you will always get the dating of the documents with that. You won't capture anything else because that's an absurd date that wouldn't otherwise be captured. You can also leave it blank. There are other strategies for this, but I prefer using this technique because I like to do things automatically. I'm big on automation because I find that computers make fewer mistakes than I do. And so that's nice if you have that confidence that so long as you program it in right and you hit Control R, right, or Control F and then select replace, you get it right. So we're going to go ahead and just plug in sort of an absurd date like that, just because we don't actually know when these documents are going to be dated. By the way, when would these documents be dated? Yes?
The date that you're filing them?
The date that you're filing them or signing them. Yeah, you'd actually date them when you sign them. And then and also fundamentally, you don't want to date things like until the certificate of incorporation is filed, there is no corporation. So other documents like that stock purchase agreement, if they're dated before the date of incorporation, it becomes sort of an absurdity. How did you sell stock in a corporation that didn't exist? That creates an issue. What's the issue we learned last week? When you have, especially if you never file that document. If that document doesn't get filed properly, yet there's a signed, dated agreement, yeah. You have a potential for a defective incorporation. And who's the incorporator? Right? So don't date the documents. Don't have them signed yet. Have them signed preferably after the document's filed. Then you have confirmation. The incorporator, the promoter is liable until then. No need for that kind of liability. All right, a couple reasons to do that. These are all just sort of boilerplate stuff. All right. The legal name. We talked a little bit about a name, what's in a name, and we know that we have certain requirements on a name, especially if we're incorporating in Delaware. And let's take a look at how to do a search and confirm that our name is available. So who wants to name our corporation? Yeah.
Anything?
Yeah, anything.
O-R-E-N Corp.
Corp, like that?
Yeah.
So we're going to start by, so if it's O-R-E-N, we're going to want to make sure there's nothing else, even without the suffix. So you're going to do the search with just the root, if you will. This will probably not generate anything. Okay. Well, there's a number of O-R-E-N type companies. So there's some risk of confusion here. This is not a course on trademark law, but you may know if you've taken trademark law that you want to have something sort of unique or not confusing. Now, I don't see anything that is Oren Corp or O-R-E-N, so I think we're probably clear. But do note that there's all these other Orens without the dash, and so, the other issue with using any type of special character in a name is that this is a name you have to input into a lot of different databases and sources. Has anyone had a password they use all the time, and it's frustrating because you try to put in that password and you can't because it says you can't use special characters? I mean, I usually just add an exclamation. I probably shouldn't be admitting this out loud, right? But I just put an exclamation at the end when it requires it. And so now I have this password, which is just like my password with the exclamation at the end. And now I don't know, I think it was Duquesne changed some rule, and now I can't use that or whatever. So I'm wary of using any special characters if they can be avoided. I'm not saying you can never use them. Ampersands are common, but I found even with ampersands, for example, I use PayPal, and PayPal doesn't recognize ampersands properly. It converts them into an ASCII format and messes them up. So I tend to recommend to my clients not to use special characters if possible, because it can create issues with putting into a database. And then, we can try that Oren, O-R-E-N.
I also meant A. I was trying to do it off of your name.
Oh, I see.
Yeah.
All right. Let's see what we got with that. So again, you want to start by searching the root just to see if there are anything with any of those other suffixes. There's actually quite a lot. And there's Oren LLC. So you create Oren Inc. There's an Oren LLC. Is there some risk of confusion there? Right, these are things to think about. It doesn't preclude it. You could probably create that company, but you do have this issue that there is a company that has that name with an LLC attached to it. There's a risk of confusion between you and another company with the same name. Might be better to pick something more robust. I guess if it was based, let me just put my whole name in there. Now the thing is, as I mentioned, I'm trying to avoid having my name on the document, right? So I probably don't want my name on the corporation. That's worth a check, yeah.
Let's try Swifty.
How do you spell Swifty? Is that S-C-H or, yeah?
W-I-F-T-Y.
Any Rick and Morty fans? They probably have that, right?
Yeah, probably.
W-I, is that right? Did I spell that right?
Yeah.
Yeah, okay.
Yeah.
And someone grabbed that, right? Swifty. Now that's an LLC, so again, we probably could file the Inc. It's a different suffix, but risk of confusion there. So somebody, some Rick and Morty fan out there. By the way, my dog's name is Morty, which makes me Rick, I guess. So Swift. Now we could have Swifty Enterprises or something. That's not going to be captured in name search, but. If my client wanted Swifty and this search came up, I would probably advise them, okay, look, there's a risk of confusion there as well. Any other names? Let's see if we can find a unique one. See how hard it is to find a unique name.
Rigor mortis.
That I probably would find, actually. How do you, like the actual condition of being like stiff as a board? How do you spell that one?
I was reading an autopsy today. I don't remember how to spell it.
I think it's R-A-G-O-R.
So well, someone's got Google, right? Someone's.
I changed my password today. R-I-G-O-R.
Oh.
I can't get on.
It's R-I-G-O-R,
And now at this point, Delaware's like, okay, guys, you've been searching a lot. Let's make sure you're not like, well, because it's trying to avoid crawlers that are just sort of capturing from its database. All right, good. So we've got one, right? So it looks like you're the winner, for better or for worse. Something we have to live with. Too soon? Okay. So we have a couple suffixes we can choose from, right? And as we discussed, we can use, these are sort of the common ones that are presented here. It really is best to use Inc. or Corp. Or Co. Because those are going to be commonly associated with being an incorporated company. And we want to get kind of that benefit. We want people to know we're incorporated. So is there any preference here between Inc., Inc. period, Incorporated, Corp., Corp. period, Corporation? So who wants some variety of Inc.? Who wants some variety of Corp? And who wants some variety of Co? And who just didn't vote? Okay. You had three choices, sorry. All right. So that looked like, okay, whatever. This is not super important. Corp. So we're going to go with Corp. Corp with a period. This, by the way, this is the conversation you have with your client. They say, I want the name Rigor Mortis. Like, okay, Corp period, Corp not period, all capitals Corp, Corporation. You have to get this right. And once you file it, it exists like this until you pay a lot of money to change it. You file with the IRS under this name. It's like, you have to get this right. And you end up, my questionnaires to my clients always like, pick your top 3 names, as we just did, because you go through the search and they find they don't all work. So, all right, you pick.
Period.
Do you want a comma before or not?
Just a C-O-R-P-S, period.
Oh.
It's how
So I don't think that's permitted. I don't think corpse period is permitted. I don't think that's a permitted abbreviation of corporation. I don't know if you're allowed to do that, because that would imply corporations plural. So you could do corp.
Yeah.
And you could do it with a period or not a period.
Period.
And do we have a comma before the corp or not?
Yes.
Okay. But I want you to understand, these are all choices, right? They're all permissible, and you have to ask the client. You have to get it right, because you file it. Some people get really annoyed. They're like, I didn't want a comma there, And there was this time where everything was like bitly, and it was like, like little bit capital L. Clients get really specific about this stuff, so you got to get it just right. Everybody happy with this, right? That you have to approval, you send it around. Everybody happy? Great.
So when you file with the IRS, you can't do capitals. It's all, they said.
The IRS, yes, that's right. And Delaware also doesn't distinguish it. As you can see from our Division of Corporation search, if we pull up something that does exist, it's all caps. It's all caps. But that doesn't mean that's how you present it when you file your certificate. Your certificate is going to have lowercase and uppercase, and the commas and the periods are recognized by the IRS. Those are part of the characters. But yes, the capitalization does not matter to the IRS. and is not searchable on Delaware, but it matters to your client and it is part of the name. It's actually, I don't actually know that, like if you want to change the capitalization but not the punctuation of the name, I don't know if you can do that without a name change. All right, so we're going to make up a street address because we've had enough fun already making up the name. We're just going to go with 123 Main Street, or even we can do, because we're going to have various addresses in here. Here, I'll give you your corpse. Yeah. Now, there can be, this is currently built for a California corporation. And so actually, if you actually use this document generator and you were doing it for a corporation here in Pennsylvania, you would have to make modifications to the documents to accord with Pennsylvania law. And by the way, you also want to check Pennsylvania to see if there's a registered, if that name is available here in Pennsylvania. It almost always is. There are far fewer registered corporations in Pennsylvania than there are in Delaware. So if it's available in Delaware, it's probably available here. But you also just want to make sure that name is available in the jurisdiction where your client is located. It'll give us like a nasty warning, I think, if I pick Pennsylvania, and that's not really the right. So this is going to give us our nasty warning over here. And our nasty warning is basically saying California has special laws against about employees. It's incredibly employee favorable, which, by the way, is, I think, not as employee favorable as it seems because it creates some issues about hiring in the first place. But in any event, it's making a warning here that if you are creating a non-California corporation, like a Pennsylvania corporation, some of the documents aren't going to work properly. And you're an attorney. This isn't legal advice, so it is your obligation once the documents are generated to look them through, make sure they work. So, all right, Allegheny, Pennsylvania. Now we get to make the election of the subchapter S. Now notice we picked a C corporation, and we could have had a benefit corporation and the S election. We could have had a C corporation and an S election, a benefit corporation, no S election, a C corporation, no S election. Those are really different elections. The benefit election that we saw on that first screen, that's going to add provisions into the document that enable the directors to make choices on behalf of society without being liable to the shareholders. This is going to add a lot of documents about sort of the tax treatment, and this does, as I mentioned, complicate things. Now, we learned last week there are 5 requirements to having an S corporation. As we're going to build this, we're going to see that those are met here. But as we attract outside investors, we run the risk of blowing the S election. And generally, just by the way, large institutional investors don't want that S election. They generally don't want those flow-through taxes because they want to have tax certainty. You don't want to get involved in a corporation and get a tax bill because they have profits they didn't distribute. So the S election, yes, it does eliminate that double taxation, but it also means that the corporation doesn't preserve its losses, and it means that you could have that phantom tax issue. So we're not going to make that S election today. We're going to keep it simple. Now we're going to enter information about the founders, and I'm going to go ahead and do something that you shouldn't do, which, well, actually this is sort of, we had talked about this, this conversation about whether or not you should have 2 founders. There's sort of a general notion that you shouldn't have 2 founders in a company, because if they're 50-50 and they don't agree, you reach deadlock, and if you can't resolve the deadlock, the company dissolves. I'm currently doing some research to see if that actually happens, because it turns out that no one's actually checked. I was sort of surprised, because this is like conventional advice I've heard for like a decade. Don't form a corporation like this. There's a risk of deadlock. Deadlock leads to dissolution. Dissolution leads to problems, et cetera, et cetera. But I actually don't think there's any actual evidence that that happens. So not to say it doesn't happen. There's just no proof one way or the other. So we'll have 2 founders here. And I usually just use like, able body. Oh, great. This is really getting... Okay, able body, sure. The other one's going to be Cain. This is how we end up with... okay, and where does able body live? We can just make, And you have to give me the address. You came up with the name.
124 Garden of Eden.
3, 4, okay. I'll do 3, 4, 4, yeah. Is there an Eden, Pennsylvania? There probably is an Eden, Pennsylvania, right? Yeah, probably. This isn't going to verify all that stuff, so we're just going to go ahead and... And again, I'm going to go ahead, since I don't, now again, this is also, I mean, I am being a little lighthearted about this, but as a practice tip, this is not a bad idea to just, if you don't know, for example, their zip code and need to produce the documents, use a unique number. That way you can go ahead and search back through. So we use 15219 for the company. Don't use 15219 again. Because if you need to change the address of able body, you know, you don't want to inadvertently change the zip code of the company. So instead, we'll make it one, we don't, let's say we just don't know, so we'll do, yeah, or 99999, you know, something that's like, 99999 is good because it stands out. It's obviously wrong. It doesn't look like a zip code that you're used to. So 99999 or 11111 was something that really stands out as being obviously wrong. All right, our second one, Kane Dyer. Glad we can laugh about something today. I really appreciate that, actually. It's nice. All right, so where does Kane Dyer live? He's going to be at 678, or 789. Yeah. Where did Kane end up going after that whole hullabaloo went down? I should. Babylon's way later. Babylon's Tower of Babel. It's like that's like Noah, the flood. Yeah. He became the whole, like, his progeny was like a whole race. How does nobody know this? Where did Cain go? He was like excommunicated from the land, right? Essentially. Okay. All right, I was gonna put him in Nod Lane. Okay. Also, is he still in Pennsylvania? At least he's still in Pennsylvania. All right. And we're going to put him again. We don't know the zip code. We're going to ask later. So a good, easy to remember. We'll do.
66666.
Okay. All right. Easy to remember. All right. So now that we've entered that information, we're going to actually now have to appoint the directors here. We're going to have to appoint the directors. Now, we don't, just because they're both founders doesn't mean they both have to be directors. Right? They may or may not, Cain and Abel may or may not want to share power. They may or may not get along. Right? You can see that there could be a dispute brewing here just by their names alone, right? So certainly a risk to have them both appointed as directors. And also, you could have directors who are not founders. You have a couple choices here. Now, ideally, again, having this two-person system is sort of a recipe for deadlock, even more so at the board of directors level, because on the board of directors, it's one person, one vote. There's no way around that. And there's no proxies, and there's generally not a simple way to resolve disputes. So now that we're talking about the board level, we're even more serious. Two founders, okay, fine, but is one going to be the director? The thing is that generally when you talk to two founders, neither of them wants to give up that power. They say, sure, there should be one director, and it's me. So there's a couple solutions. One is that the attorney is the director. That creates its own set of ethical constraints and problems. I'm actually going to be covering that. I keep on referencing the course that I'm not teaching next year, but I am teaching us an intensive week-long course in France, and I'm going to be covering that ethical issue, whether a lawyer can be a director. But you've got an issue here, right? You've got these, you have two founders. If you make one of them the director, the other one might be ticked about it. If you make both of them the director, then they could deadlock and disagree. And if you have three directors and the third one is going to be, the attorney, you have some ethical considerations now about whether the attorney can really serve in that role. And if it's just someone who's on the outside entirely, why would they be motivated to contribute? They're not getting any stock. This is a startup company. They may not have salary to pay. So these are all reasons why a two-person board is challenging, but also, as we can see, the one-person board and the three-person board, where there's an outsider, are a challenge. So how would we yes?
If you had like a three-person board, could one person fill two positions on the board?
Not as directors. We're going to see a place where that does happen, but each director needs to be a separate natural person. So if you have two seats, they have to be two different people. You can't have two seats filled by one person who is in both seats. You think of it, part of it, you think about that a director has to be a natural person. You imagine they're literal chairs. How many natural people can sit in two different chairs? You need at least two, right? Musical, right, two. Two is the answer. So you can't actually have one person fill both of those director seats. If that's what if that's what you want, you could just have one director. Or you could have 2 seats and have one open and you figure it out later. But if they're both shareholders, there's an immediate opportunity for a vote, then there's already 50-50, you have a recipe for deadlock right out the gate. So how are we going to advise this client? Should we just allow them both to be directors and hope that they don't kill each other? I think we'll just do that. We'll hope for the best, right? I mean, history doesn't repeat itself. All right, so we have
He went to Canaan, by the way, which is really straightforward.
Oh, that's right, Canaan. That's why it's probably named that. Okay. Well, fortunately, we can go back and change the address later. So now we're going to have to appoint the officers, and unlike the directors, one person can fill multiple officer roles. They're not kind of like seats, and they don't all have a vote. They all have different obligations, and so we can have we can have either one person who fulfills the role of all the directors, or we can divvy up the responsibilities. In the example that I gave, in the hypothetical that we presented, we really had people who had different talents. One person who had some financial experience, one person who had more operations experience. And so, similarly, here we would really want to know what they intended to do. Now, the role of the chief executive officer, we're going to see this more in authority. Being the CEO connotes a certain amount of authority to bind the company. So the CEO would be someone who would be expected to negotiate contracts, to be sort of the lead figurehead and face of the company, who would be signing the primary documents most of the time. All the officers could be authorized in the bylaws to do these things, but the CEO is really that figurehead person, and often in a startup company is going to be the one who's signing most of the documents. And usually, the president and the CEO at this stage are the same person. And whether or not they sign as president or sign as CEO is a very minor technical matter, but often someone will be the president and CEO. It's most common that you would have the same person fulfill both of those roles. It's very unusual in a startup for someone to be the president, someone to be the CEO. More common would be 2 different people who are both co-president. Now, why do we even have these 4 titles? These are just what people expect. When, it's not necessary to have these exact names, but this is what people expect when they're dealing with the company. They expect to be talking to the CEO of a Delaware company. You might, IBM wants to do a deal with the company, and the vice president at sales says, I want to talk to the CEO, right? So you want to make sure you have that role filled so that we can do that. So on the other hand, the chief financial officer probably should be somebody different if possible, because that provides some level of independence. And ideally, the secretary is someone other than the CEO too, because as we'll see, sometimes the secretary has to certify something has actually happened. And it's sort of, while it's theoretically possible, while it's legally possible that the secretary certifies what the CEO did is true, and they're the same person, if you're on the other side reading that, you kind of think, well, that's crap. So it's better to have more people involved so you get more signatures on the paper and you have a little more confidence that authority actually occurred. So better strategy to have more different people sitting on the board. And by the way, this is a place where sometimes the attorney, again, comes in, and the attorney could be the secretary, or more likely, acting secretary at a meeting. We're going to talk about meetings either in 2 weeks or in 3 weeks, minus Thanksgiving, so what is that, 4 weeks? So we're going to cover that a little bit more about the meetings and how those processes work. But for now, we're just going to go ahead and assign them responsibilities like this. This way, Kane can certify what Abel has done is true, and we at least have 2 people on a document. That's going to help us show the outside world that something is actually authorized. It's technically possible that Abel fulfills all of these roles, and in fact, you can see both of them are fulfilling 2 roles, sort of wearing 2 different hats. But the CEO hat and the finance hat are pretty different. The finance hat is a position. There are certain things that the finance officer has to certify. There are certain things the secretary has to certify. And so since these are officers that provide certification, it's nice, it's helpful if they're different than the officers that actually execute the document. That way, the signature is certified by somebody else. Does that make sense? So this looks like a good setup, better than our director situation. See if there's, and so we can move on then. All right, fiscal year. So the idea of fiscal year is that you can change when your fiscal year is, and this really only matters for annual reporting. And essentially the only time anyone changes this for anything other than the calendar year is when they're a public company and they care about earning reports. So companies like Apple sell a lot of their products over Thanksgiving and over Christmas, Black Friday and Cyber Monday and into Christmas, right? And that's why you've probably noticed, well, maybe you haven't, or haven't thought about it, but Apple usually does its major product announcements in September, October, and into November. They just had one, right? They just released a lot of new products. Why? Because, well, I just got my brochure from Costco. It's full of Apple products. It's usually full of diapers and adult diapers for whatever reason. Have you noticed that? Costco's always has adult diapers on sale. But this time of year, they switch over to iPads. So, this is the time of year people, are preferring to buy iPads. Or maybe the people who'd usually spend their money on adult diapers are now thinking of the grandkids and buying the iPads. And so, we have this cycle. Now, they're not going to be able to report those earnings on December 31st because they have essentially some lag time between when they make the sales and when it makes into reports and things like that. So they may have a different year end date, and I'm sure that they do. I don't know offhand Apple's fiscal year end date, but it's basically a marketing reason. If you have a private company, unless there's some very special reason, just leave it alone. It's almost always December 31st. That way, it just coordinates with the calendar year end, and it's just sort of simple, straightforward. It's what people expect, and it accords with other things like, Delaware has their tax due on April 1st, and so you have, and the IRS, right? And so you kind of in line with sort of the world at large. So, long story short, on fiscal year end, you have the choice to change it. You can set it now, you can change it later, but unless there's some kind of essentially marketing reason that has to do with your annual reporting, there's no reason to change this date. And for a small company, that's just irrelevant. Does that make sense? But if you go ahead and you look at, when does Ford have their fiscal year end date? When does Apple have their fiscal year end date? When does whoever makes adult diapers have their fiscal year end date? They're going to probably be not December 31st if they're a public company, because they want to have those reports come out at certain times to time market cycles so they have a lot of sales right when they're coming out with their annual report and their annual meeting of shareholders. I mean, think about it from a director's perspective. You want to have your best results right before the shareholders vote whether to keep you or not. I mean, look at what presidents do, right up to an election, right? They run around kissing babies and visiting Pittsburgh and stuff like that. So why are they doing that right now? Why are politicians more active right before an election? Well, obviously, they're trying to court favor. Similar here, and you can sort of modify that. All right, now for some incorporator details. So, as I mentioned, a lot of companies don't necessarily want to provide all their personal information right off the bat. And you don't need the incorporator to be a natural person. The directors have to be a natural person, but the incorporator can be a natural person or another firm or a partnership or another corporation or the attorney, a number of other things. So I, in practice, typically filled the role of incorporator. So I'll go ahead and do that here. Or in fact, instead of just call it generically, right? And this gives me a chance to talk about sort of another drafting tip. Common in transactional drafting is the use of brackets, and brackets means this is going to change, or this could change. Right? So the use of brackets like this is to indicate that this is not, and this again, this might sound really dumb, and it kind of is, like really simple, but this is just to make it easier to find this stuff. I mean, if I hit Control F, and I search for open bracket, I can find in my document all the things I intend to change. So the use of open brackets, as silly as this might sound, is a great way to just facilitate, the modifications necessary in the document. So if you're not sure which attorney in the firm is going to be the incorporator, you could even, call it. Because you may have to generate the documents before you have all the information. How are you going to go back in and revise those documents in an efficient manner? I mean, now you can just do Control F, right? And if this were Microsoft Word, you know how to do replace, right? You've seen that feature. You do Control F and you have a drop down, you choose replace. And now you just put in the name of that person and it populates that throughout all the documents. So we can use that as well here. And this even in fact gives the option of doing it through a third-party incorporation service. I think I've showed you some of those services. Delaware has a list of them. Right? I mean, they have names like Delaware Inc., right? Delaware Incorporation Service. So again, this is a business. It's a C corporation. Unsurprisingly, it's registered in Delaware. Probably actually operates in Delaware. Very few Delaware corporations actually operate in Delaware. But here we have a Delaware corporation that has the function of being the incorporator. It will do that function for you or for your client. Because fundamentally, key thing to remember, the incorporator does not have to be a natural person, but the director does. And so we're going to need that action of incorporator to transfer power to a natural person. In any event, we're just going to have other for now. And we could have, use our bracket technique here. Okay, now the registered agent. The registered agent is really like every attorney I've talked to has no idea of how to compare any of these. There are so many different registered agents. Some of them just become more popular than others. I choose the cheapest one because I have never found them to offer anything useful. But maybe they do. I don't know. I haven't done enough research because generally I do all that work myself as the attorney. But as far as I know, they're just a tax, essentially, where you have to provide an address where they can take process. And there are some that are more expensive than others. So Corporation Services Company, I think, is one of the more expensive ones. Some of them range up to, so this is the one I use, Registered Agent Inc. Right, and you can see their ads here for $50. Here's a comparison here, so you can just see a little bit of the difference in their prices. But you can get it for as little as, oh come on, what's this business? Right, you can get it for as little as $49, and you can spend as much as $350. Here's $275 for a company called CT. I don't know what they offer. To be honest, I just don't know why they end up charging more. I don't know what they offer that's valuable. It's a website you log into. It tells you if you have any filings, tells you when your taxes are due. You pay their bill regularly. So I usually go with the cheapest one, but there is some, it's called in economics we call it path dependence. People do what they have done, right? And so some of the bigger names are just popular because they're big names, they continue to be big names, and I guess they give some kind of confidence. So if you have a really wealthy client, they probably want a good registered agent. So you pick one of these from the drop down. If it's me, I'm cheap. I go with a Registered Agent Inc. or one of those $50 ones that basically is just a website. In any event, we're going to go with Corporation Service Company for now. Our client's paying the bill, so we don't care. No, you should be responsible about not having your client pay fees. Let them be aware of this issue. Let them know there's cheaper options available. But a lot of times, again, if they're a small business that isn't planning on raising outside capital, they're going to think about minimizing cost. If they're a larger business or if they have an anticipation of growing and raising outside capital, if they think they're going to be a billion-dollar company in 5 years, they probably don't care about $50 versus $275. They probably want the Cadillac service, as you might call it. So ask your client how much they want to spend, but I usually advise them that there's really no benefit to a more expensive company aside from name recognition. But keep in mind, this is public, so when you search the company on Delaware, you see the registered agent. Is there some cachet that comes with this? Maybe. So we'll go ahead and search Corporation Service Company. All right. Transfer restrictions. So one of the things we learn about a corporation, the nature of a corporation, a way that we distinguish corporations from partnerships, is that your interests, your shares in a corporation are freely transferable. But there are a lot of limits on that free transferability. It's very hard to sell your share in a partnership. I mean, in part because we get into a partnership, we're going to do a lawn care business because I'm really great at cutting the lawn. I'm actually terrible at it. I've started a lawnmower twice in my life, so you probably don't want me to be doing that. But so you figure out that I'm terrible at starting the lawnmower, you want to get rid of me and replace somebody. It's hard because a partnership is really about the people involved. It's usually one person, one vote. Whereas a corporation, the idea is that the shareholders are passive, they're just money, who cares who they are? So those shares should be freely transferable. If I just own stock in the lawn company, why? Who cares if I sell it to David? It doesn't matter. I mean, so long as he's a minority shareholder, he's not going to vote you out. But there are some reasons to include transfer restrictions. For one, if the shares are transferred illegally, that can create issues for the company. This isn't a class on securities law, so whatever. And also, if enough of the shares are transferred, that could add up to voting control. And then the directors are out, the CEO is out, the whole company changes over. So usually, startups will include some transfer restrictions. And one place we can put those restrictions that they're commonly found is in the bylaws. And so we're going to go ahead and add that. And it says here, and this says what it is, transfer restrictions require stockholders to obtain consent of the company in order to sell shares, meaning the company can refuse to allow someone to sell shares. There are a number of other ways we can restrict this. As the company grows and gets venture capital investment, these transfer restrictions can also occur contractually, but here we're just going to put it in the bylaws. And then there's an additional restriction called a right of first refusal. So if the shareholder wants to sell their shares, the company gets the right to buy them back first. And so it's sort of what we call a belt and suspenders, meaning double protection. So the company could refuse to allow the share, or it could permit the share but end up sort of taking the place of the buyer and repurchasing those shares instead of them being sold to a third person. Yes?
If somebody buys shares from someone who wasn't authorized to sell them, and like they pay for them, what happens?
So if someone purportedly buys shares and that were not authorized to be sold, now we're getting a conversation about corporate authority, because now we have a person who thinks, it depends on a lot of factors. It's really an authority question. If a person, so now you have, essentially the short answer to your question is that sale is invalid. That share generally is invalid. But there's a bigger conversation about what happens when a person claims to be acting on behalf of a corporation, another person believes them, and it turns out not to be true. And that's the whole subject of our next chapter. That's the concept of authority and agency in general. And so, short answer, that sale is invalid. Bigger answer, stay tuned for the next 3 weeks. We'll talk about authorization and how that can limit the validity of a transaction in general. By the way, if you're buying shares, you should do certain things like read the bylaws of the company. And if you're a company and you have these, we're going to see a share certificate. So if you're buying shares, you should ask to see the certificate. And on the back of the certificate, we're going to print these shares are subject to a transfer restriction. So yeah, it's possible that someone will forge the document and print a fake share certificate and make up BS bylaws that don't contain the restriction and then bamboozle somebody into it who's too stupid to ask for the secretary to authorize something. That's sort of a corner case. In general, we're going to have bylaws that say you can't sell the stock, shares that say the stock can't be sold without company approval, and then if you're a buyer who reads the bylaws and reads the share certificate, you should go, where's the approval? Right? Put you on notice. And we're going to see how that becomes noticed when we look at the restriction on the certificate. So let's include these just so we see what they are. And again, these are kind of belt and suspenders, but they serve slightly different purposes. There are other concepts in transfer restriction. There's also something called in addition to a right of first refusal, a right of first offer. There's lots of ways to restrict shares, but these are sort of the basic two. Fundamentally, though, what do you need to know about this? They go in the bylaws. They also get printed on the stock certificate, but the transfer restrictions are in the bylaws. Now, our stock purchase agreement. So, I have mentioned before I have a technique to minimize your Delaware tax. And actually, let's take a look at that. I will pause on this issue because this website does not address this. Talk about Delaware franchise tax. Delaware taxes can be expensive. And I will show you how they work by looking at a calculator. So yes, if you want to be a corporate attorney, you will have to learn to use Microsoft Excel. Fortunately, to a large extent, there are automated systems that do this. There are two methods used to calculate the amount of tax you pay in Delaware, and you obviously want to pick the one which is going to be most favorable to your client. There's the authorized shares method, and there's the assumed par value capital method. And you can see them both here on this Excel sheet. We're going to calculate them separately. So the authorized shares value method is simple. I like simple things because they're easier, they're cleaner, there's less risk involved, you don't get it wrong. So, simple. You authorize 5,000 shares or less, you pay how much tax? 175. So, simple. Way to get the lowest tax in Delaware, authorize less than 5,000 shares, 5,000 shares or less. So if you have a startup company that doesn't have employees yet, blah, 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 you can save quite a bit of money. It's not that expensive to revise their certificate. You can authorize more shares later. This is not standard practice. I'm sort of rogue on this one. Most of the time you authorize 10 million shares, and then you divvy them up between the founders. I prefer this method because it simplifies the whole tax process, and it prevents a sticker shock issue that will come up in a second. But here's the sticker shock issue. So let's say you go ahead and you follow Cooley's advice and you authorize 10, oops, I missed a 0 there, so it gets worse in a second. What happens if you authorize 10 million shares? What kind of tax bill does your client get in the mail?
A nice one.
That really scares the pants off of Cain and Abel here, right? They're going to get into a fight over that for sure, and then you're going to be the victim. Because they're pretty upset when they have this little tiny dinky startup company and they see a bill come from Delaware for $86,000. Yeah? Not cool. You want to let them know that that's coming. Now, fortunately, you don't have to pay that tax because you can use a different method called the assumed par value method. But is everyone clear that if you have 5,000 shares, that number is a lot simpler? The calculation's a lot simpler. Now, this doesn't fit every case. But in my opinion, when you have two guys starting a company and they have no employees, no this, that, the other thing, why not keep it simple until you need it? On the other hand, Cooley and other companies will give the advice that you should start with a robust structure that doesn't need to be revised as soon so you can issue more stock options and things. Different schools of thought, depends on the type of clients that you have. I'm not saying one is always right, one is always wrong, but I can tell you, after having gotten phone calls from my clients who don't like when this happens, or whatever, the maximum is $200,000. I did have a client that had some number like this. Their idea was actually, somewhat sensible. They said, well, when we hire like an engineer, they expect to get 100,000 shares. And, engineers you might think are smart, and some are, but, there's optics. We call this optics. So, you get 100,000 shares. It's awesome. That's totally worth it. I'll totally work for peanuts for 100,000 shares. Okay, well, 100,000 out of 100 million is not a large percentage. Whereas if you have 5,000 and you give them 2 shares, they're like, 2 shares? This is crap. I'm not going to work for you. It's the same percentage, guys. Like, no, those are not exact, but you get the idea, right? It's about the percentage. What you get is a percentage. So if you get 1 out of 1,000 shares, it's the same as getting 100,000 out of 100 million shares. It's the same thing. But there's optics involved, and people like that, big number on their share certificate. So there's a reason to do this, but then you get this tax bill. On the other hand, you can then file under a different method. Now, the minimum you'll pay under this method is higher, and you have to do a couple things. You have to actually estimate assets of the company. So now you get into this kind of relatively, I think, messy area of evaluating the value of a startup company, which, I haven't seen this happen, and I'm not a tax attorney, but what if you get it wrong? Basically, startup companies don't hire accountants to come in and decide how much their computers and their intellectual property and their pencils and their inexpensive lease, how much all that's worth. Right, so what is the value of a startup? It's kind of arbitrary how much its assets are worth, especially its intellectual property, its patents, things like that. So let's just say that, and the other problem with this is that you kind of want to be a little conservative and estimate something higher so you don't end up getting like taxes and penalties, right? So let's say our new company has some good IP and they're worth, Oh yeah, and there's also like pride in this too, because the founder's like, yeah, our company's awesome. Like, of course it's worth $500,000. And then they're telling investors that their company's worth $5 million because they're trying to sell stock at a price. Anyway, can you see how this creates a little bit of slippiness? A little Pittsburgh there for you, slippiness. No one even noticed it, so okay. Right? Slippy, right?
Yeah, slippy.
Yeah. All right, so now if we have, and now we have to this assume par value method, and so we can have our 10,000 or 10 million shares. This is where we want to set our par value as low as possible. As I mentioned, we can play with that par value. We want to set it as low as possible, but no matter how low we make that par value, we're not going to go under $400 for our tax. Now again, for a large company, for a company that makes a lot of money, $175, $400, Delaware tax, whatever. It's you earn that in minutes. But for a smaller company, maybe one that doesn't have a lot of revenue, you're really trying to be conservative on their tax base. Having a large number of shares is going to cost them from a tax perspective. Yes.
Why did we put .0001 when it calculated .05? Why did we?
This is their actual par value. We're going to go ahead and put that par value in there. We can actually set the par value. And for a little bit of time, when the company's young, we can actually basically say that the par value is less than the assumed par value, and Delaware usually doesn't audit that. But as the company starts to be profitable and the company starts to actually make money, you have shares that are now $1 a share. And this is how Delaware makes its money. Once the company is actually profitable and there's actual evidence that the shares have value, you can't fudge that number anymore. So I'm just talking about like the first cycle through, but. As we go up, we're going to see shares, what's a share of Microsoft worth? Right? They're going to be paying the maximum tax again. Anyway, not a course on tax, but I want to just kind of indicate a little bit of that consideration for you and let you know that while we're using this Cooley calculator to come to some consensus about having 10,000 authorized shares, I don't personally follow that logic for all companies, and I don't think it's a rigorous application here. I think that you should think about it, whether your clients actually need that, whether people are actually coming around to the idea that percentage is more important than number of shares, et cetera, et cetera. But okay, for now we've got our two founders. We have 10,000 shares. They want to be 50-50. And this is sort of a trick question. You have two founders. They want to be 50-50. How many shares do they each get? There's 10,000 authorized shares. The founders want to be 50-50. How many shares do they get? Okay, that's the trick question answer, right? The answer is you do not put 5,000 here. If you're going to put 5,000 here, you might as well have had 2 shares and give them each 1. Why do we create shares that we authorize and don't issue?
So you can sell them?
So we can sell them, so we can incentivize employees to join the company by offering them stock options so that we can distribute them later, right? We're actually not going to ever we're not intending to issue all the shares. The reason why we have such a big number is so we can authorize, issue additional shares later, especially in small increments. So, right now you have David and Danielle, who are the founders of this company, and later they're going to bring Tyler onto it. And, Tyler's going to come later. He's going to take on less risk. CEO, CFO, major roles. Tyler's going to be VP of Communications. You're good with Twitter, right? Not so good with Twitter. Okay. So he's not going to last long. This is why you have stock vesting. Now, Tyler's not going to get a 50-50 share. You want to give him some stock. He's going to, and you need to have some negotiating room. So maybe he wants 5% for that because of the risk he's taking on. So you want a fair bit of shares left over. Well, how much that is? Again, this is a conversation with your clients. How many shares you leave authorized and unissued. It really depends on their growth plan, on their strategy. If they plan on hiring a lot of people very quickly, you might need a couple million shares under this, 20%. And that remainder left over is going to be used to form what we call the option pool, an additional set of stock that hasn't been granted yet, but could be used to give stock options. Now, you mentioned selling stock. Usually, if there's a sale of stock, investors want to buy a different type of stock. They don't usually buy common stock like this. They're going to buy preferred stock. They're going to buy stock that has additional rights and preferences. And again, that's a conversation for venture capital transactions. But they're not going to usually buy this kind of common stock. They're going to buy a set of stock that has additional rights and privileges not in this stock. And so we're going to probably have to go through the process of amending and restating the certificate of incorporation to create a new class of stock for that purpose anyway. And by the way, we could even find that if we look at the documents under Cooley Go, this could be it really is a separate conversation, but you can see this Series Seed equity financing package. This is going to generate the documents needed, and one of those documents is, there you go, amended and restated certificate of incorporation. When you sell stock to investors, when you get an equity investment from investors, you're going to amend and restate the certificate of incorporation, creating a new class of stock, in this case called Series Seed. So really what we're thinking about with this initial charter is about early employees and stock options. So if you want a 50-50 set of founders and you have 10 million shares, you don't give them all away. Now, how many you give away? Totally up to you. It needs to end up being 50-50, so it could be 1 million, 1 million, it could be 2 million, 2 million, 4 million, 4 million. You have to have some set aside, and it really depends on your growth plan. But as mentioned, if you're only going to give away 1 million, or some other kind of scenario, why authorize this many shares? All right, so for now, let's go ahead and just put in, is that right? 1, 2, 3, 4 million each. We'll make them 50-50 founders. So here's the concept of vesting. I'm going to go ahead, I'm just going to hit yes just to show you what this is. We could have percentage shares, sub-tier vesting, options for vesting start date, time period, and whether there's a cliff. This is all acceleration for change of control, acceleration for termination without cause, acceleration for terminating with cause. These are all factors and interesting things to talk about in venture capital transactions, not relevant for today. So we're going to go ahead and select no vesting. Where did that option go? No. Vesting means that your shares are subject to a right of repurchase by the company, and that lapses over time. It, by the way, could also lapse as events occur. That's called milestone vesting. That becomes more contentious because you can argue about whether a milestone was hit, like, 1 million shares will vest when the product is launched. What does launch mean, right? It's hard to define, whereas time, it's pretty easy to define, like what a month is. But we're not going to worry about that concept for this class. Did you have a question?
I did. So if there are 50-50 founders,
Mhm.
and we want to make sure that obviously they have equal power, can you put a provision mandating one founder to notify the other if they would want to purchase additional stock?
Yeah, that was, yes, and we have that in this bylaws restriction. If anyone wants to sell their stock, if Kane wants to sell their stock to his mom, whatever, or to Abel, the company has to be notified and approve. And so since he is 50-50 on the board and the directors need to approve the sort of transaction, he has a blocking right against all of those transactions.
Even for him to purchase more?
Yes, even for him, absolutely for him to purchase more, because only the board of directors can authorize the sale of stock from the company, and only the board of directors can authorize the company to give consent to the resale of shares. And since they are 50-50, and since they are both each one director, and you need a majority, they each effectively have a blocking right on any of that happening. But, as to your point, if only, let's say only Abel was on the board, and Abel wanted to sell his shares to his mom, who approves that? The company. Who votes, who speaks for the company? Abel. Now, we're going to talk about this toward the end of next semester. That's a conflict of interest transaction. He stands on both sides, and we may have to appoint someone independent to deal with that. Complicated issue about invalid transactions because of conflict of interest. But here, just as a fundamental governance point, that's how it would function. But we do have that. We do have those fiduciary duties that provide some backstop to that. All right, so going back into the purchase details, so they each get 4 million shares, meaning they're not subject to vesting, which means they get to keep them no matter what. So this actually could be a problem because, if Cain kills Abel, God forbid, those shares stay with Abel, and so they get inherited, by. Actually, who would inherit them? He didn't actually have kids, did he? Do you know how this worked, by the way? Who was the There's a third guy involved here. Yeah. All right. So this would be an issue, though, because now who's going to inherit those remaining shares, and how is that going to affect the company? So again, we deal with this in venture capital. What happens upon the death of a founder, if it happens before the vesting start date, and matters like that. A little bit beyond the scope of what we need to deal with today. All right, then we have our IP rights. I'm actually going to go ahead and check no, because we're not going to deal with IP in this class, but just so you know, it's important for the company to own all the intellectual property. And so this is not something you'll be assessed on here, but as you go forward in your practice, and as you learn about IP rights, it's important to know that we have to find some way to get that IP into the company. If it's owned by the individuals, the company essentially has no value. It's like an empty shell. And that's not going to help with getting investment. The investors want the IP in the company because they're investing in the company. But we're not going to worry about that right now. Congratulations, we're done. We can download the documents. Good. So let's go ahead and download the documents on the next screen here. And spend the rest of the time taking a look at actually what we have created now that we have stepped through this process. By the way, not that hard, right? I mean, you had to know a little bit about some of these things, and you can see there are some hidden traps and tricks and considerations as you go through here. But the actual process is relatively straightforward, and it generates a lot of paper.
How does it generate them, in Word or in PDF?
These are in Word formats. And they need, fundamentally, it's so important they're in Word format because you have to edit these. They're not, you have to check them all. This is just, you cannot just take, this is like a little bit better than LegalZoom, but you need to do the work, yeah. I mean, Okay, so let's take a look at some of what we generated here. So I'm actually going to start, I'm going to come back to, actually, let's start with something simple. The action by incorporator will be simple. So remember that the attorney was the incorporator. And so we see here we've used that bracket. Easy to find, replace, we can change that. And the incorporator does one thing, well, aside from incorporate the company. They incorporate the company and then they assign it, they appoint the directors. And then step aside. And so actually this is our first look at a resolution, and the incorporator now is, the company is the incorporator because so far all that's happened, the incorporator formed the company. We haven't sold any stock, we haven't created a bank account, we haven't appointed officers, directors. The incorporator is the company. But they're like a trustee or a fiduciary, and so they have one role, going to form the company and then step aside. So here we see that the incorporator is going to simply appoint the directors and then resign. Pretty simple. But this means that who is actually the incorporator is not the directors, and so you could have a company do this or a law firm do this, and so the directors, they will have to sign their names and be on the annual report, but at this stage, they don't have to publicly file that. All right. And again, I'm going to post all this stuff so you don't have to worry too much about capturing every detail, because you should take a look at these. I mean, what do we have, like 7 pages of reading left for the next month? So it's not really, because I have these documents for you to look at as well. All right, take a look at that on your time there. So what is that incorporator going to file? They're going to file the certificate of incorporation. Remember that this is Delaware, so it's a certificate. Other jurisdictions might call it the articles. Same difference. Open that in Word. And we're going to find then the articles. The undersigned, the incorporator, right? Because who is filing this? The incorporator, which could be a corporation, and who will step aside after completing the incorporation, is going to form the company. And what do we need? We have the elements here. The name. Rigor mortis, comma, corp, period. Right? And make sure your clients like it before it gets filed, because it's a pain to change. The registered agent and the address of the registered agent. Who is the registered agent? And by the way, this is weird, but it has to be written this way. You have to actually state the county. Just kind of a quirk. But they want to see the county, and so, I think there are only 2 counties in Delaware. I think there are only 2 counties. Newcastle and Dover? Yeah. It's not a big state. Mostly what they do is collect corporate taxes and that damn bridge. So 2 counties, 2 sorts of income, that's about it. The purpose of this corporation is, anybody surprised? Any lawful purpose. It's written in a little bit, more robust language, but here you go. Every document's going to see this. Why limit it here? Why create liability to the outside world, not even vis-a-vis your shareholders, right? Authorized stock, and here we're going to include that par value. Now, we could have no par value. The problem with no par value and 10 million shares is it screws with our calculator. So we're going to need par value if we're going to use the assumed par value method. Of course, with the authorized share method, you could have no par value stock. Par value is that kind of outdated concept. The only thing you really need to know about par value is you can't sell the stock for less than its par value. If you do, you've sold watered stock, and that creates a lot of issues of whether the transaction was valid. But we're going to make that a tiny, tiny number. Here, 0001, we can make it quadruple 01, right? It's a fraction of a cent. And then a couple other provisions here. The business shall be conducted by the board of directors. You could specify the number of the board of directors here, or you could do what this document does. The number of directors shall be fixed in the bylaws. Why is it better to put the number of directors in the bylaws instead of in the certificate of incorporation? Yes?
You can amend bylaws.
You can amend bylaws a lot easier. How do you amend the bylaws? You write them and you vote. How do you amend the certificate of incorporation? You file it with the Secretary of State. You pay a filing fee. So anything that you can put in the bylaws, put in the bylaws. Plus, this is public. People can search for this. Why reveal anything you don't have to? So we're going to put that in the bylaws, not in the certificate, as is done here. It's sort of a best practice. Some other provisions here, directors are elected at the annual meeting, blah, blah, blah. You can read through this on your own time. You should read through this on your own time. We're not going to sit here and read bylaws to you or articles to you or certificate to you. A couple other, provisions there. Now this section 6, is about liability of directors, and we're going to focus on that next semester because we're going to talk about 3 things next semester: liability of shareholders, liability of directors, and liability for securities issuances. Those are our main topics for next semester. So we're going to come back to these bylaws. We're going to focus on Article 6 because Article 6 is going to have our indemnification and our insurance provisions in here. Or here, I guess this is, and it doesn't necessarily have to all be in 7. This looks like it's all indemnification and limitation of liability, and I guess they actually don't seem to have an insurance provision. I always write insurance. I always, in my bylaws, on my articles or certificate, authorize the company to have insurance for its directors called D&O insurance. This one doesn't seem to have it. In any event, subject for next semester of how to protect directors from liability and when directors have liability. So that's what this is about. Amendment procedures, and then the address of who? The incorporator, not the directors. The directors don't exist yet. So actually, I probably should have shown you the other. If we're doing this in time series, this is the very first document, really. The second document is that initial action. Once that document is filed and the corporation exists, that's my third one. Right, the very first thing that happens is the certificate gets filed. The second thing that happens is that the incorporator appoints the directors and steps aside. And the third thing that happens is those directors are now going to act in their first action. So we'll just spend the rest of the class today just reviewing this briefly, and I'd like you to look at this in your own time so you understand exactly what happens next. So this is an action by unanimous written consent. Next week, and the week following, we will talk about the meeting rule. We will talk about how directors act at a meeting and how they can act without a meeting. That'll be the subject of the next couple weeks because it all has to do with authority. The directors have authority in certain contexts when acting as a board. So this is in lieu of an organizational meeting. So this means that they never actually sat in a room and talked to each other. They did this by writing. And that is permissible, and we'll learn about that in the next 3 weeks. Okay, and we have some kind of language here, the undersigned being all the members, and so one thing that you'll see, and this should remind you of that, but we're going to be kind of learning a bunch of different things together over the next couple weeks. If you have a written consent, not a meeting, it has to be unanimous, and so the language here provides the undersigned constituting all of the members of the board of directors, adopt the following by unanimous written consent. So you can act without a meeting, but now you know it requires unanimity. We will again return to this after we discuss the meeting rule. First thing is the appointment of the directors. So the directors that were appointed, this is sort of a ratification. We'll also talk about that concept. Remember, the incorporator had just appointed the directors, and now the directors are kind of appointing themselves. It's a little bit of a chicken-egg problem at this point, and best to see this as a ratification. And I don't write it this way. I would revise these to call this a ratification of the action by incorporator. Because remember, the incorporator appointed the directors, and now we have this appointment of directors language again. I would change this. I would call this ratification of directors. And we'll talk about how a ratification works. It relates back to the original time. But you get the idea. Now we have at least some certainty that the sole incorporator has stepped aside and the directors have taken the place, and now the directors are running this company. The certificate of incorporation is ratified, right? That approved by the directors. So now that the incorporator did it, the directors are coming back and saying, we give our stamp of approval to that document as well. Next action will be to elect the officers, because the officers now have to act for the company as well. And so this is also going to be granting authority. Right? We have to appoint them and then give them some power. The power comes from the bylaws, but the appointment comes here in the organization. We're going to actually name who these guys are. We're going to adopt the bylaws. We'll take a look at that next. The bylaws have quite a lot in them. They're a little bit more detailed. And we're going to authorize some specific actions. We're going to authorize filing an EIN, an employer identification number. And by the way, you don't have to worry about capturing it. You will have this document. So you don't have to worry about necessarily capturing it all right now, because you will have this inbox this evening, and you can just look at the headings here. We're going to capture we're going to file for an EIN, and that's going to create this company from the perspective of the IRS. It's going to almost like creating it's like, look, you have a kid and you have a birth certificate and it gets a social security number. This is like your new baby, right? This is your baby corporation, and it gets an EIN, which is just like a social. It's a way of recognizing it in the state. Authorized to withhold taxes. This is sort of sometimes it's called an omnibus statement, a statement that's like very broad, right? A broad concept, but we're going to allow the company to qualify to do business in foreign jurisdictions, which is going to be necessary for Pennsylvania. We have to register the business. Let's say the company is actually here. It's a Delaware corporation. We have to register it with Pennsylvania. So we have to authorize all this stuff. This is express authority. There's an express grant of authority from the board of directors to the officers. And in fact, it says it here, right? It says the company be qualified to do business, blah, 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 and that the officers are and hereby are authorized and empowered to execute and file with the Secretary of State of such jurisdictions any documents and the like. This is an example of an express grant of authority, actual authority expressly granted. This is a bunch of stuff about creating a bank account. That's important. We'll learn about this in corporate veil piercing, but we can pierce the corporate veil and have liability for the shareholders if they don't have a separate bank account and they're using the corporation as their piggy bank, so it's important to create that bank account right away. And again, everything has to be authorized. We're going to set that fiscal year, set the principal office, management powers, issue stock certificates, and here we're going to authorize the sale of that stock. Only the board of directors can sell stock, so you can't delegate that power. It's one of the few things that can't be delegated, so here the board is going to sell that stock. And by the way, it's being sold at the par value. What was par value? 0001. What's 4 million times 0001? Hopefully it's here, $400. Not that expensive. Not free either. You want to make it $40? You add a zero, right? This is all about the sale of stock, sale of stock, sale of stock. Indemnification, that's that paragraph 6 that we'll come back to, indemnifying the officers. Ratifying the actions of the incorporator, right? Next week we'll talk about what ratification means, but essentially it's approving now something that happened in the past and it relates back, so we're essentially giving the stamp of approval on what the incorporator did. And this is our classic omnibus provision. Resolved, they're authorized to do anything else necessary. And so this is attempting to grant authority for anything else that's sort of related to this. It's, again, more belt and suspenders. It has to be signed, it has to be dated. We attach all the relevant documents to show that the directors actually read it, so we have that there. All right, so again, take a look at that in your time and just have a sense of those things that need to be done at the formation, right? And we'll post that, and you can take a look at all those things that have to be done. A quick look at the bylaws. The bylaws are long. They have a lot of provisions. They're annoying, but once you get used to them, you get pretty quick at reading through these. And what you do is they're generally organized in a similar kind of way, and you can skip to the you don't read. I mean, that's the thing about corporate law. You don't read anything cover to cover, right? You go to the provision that you need. And so some of these documents are really long, but they're really meant to be more like reference materials. It's like you don't read. I mean, so Black's Law Dictionary is 900 pages. Okay, so what? You're not going to sit down and read it cover to cover. You're going to look up promissory estoppel if that's a concept you need. Similar here. You want to understand how many directors are needed for a quorum? First off, you need to know where to look. You look here. This is where most of the action is. And then you just look to that provision. So, provisions about meetings and notice of meetings. Here's our stockholder quorum. Actions without meetings. Organization, directors, number of directors. And here we actually are even saying we're not even going to set them here. It shall be fixed by the board from time to time. Where did the board do that? If you went back to the number of directors shall be 2. So the articles of the certificate of incorporation said it's set in the bylaws said it's set by the board, and the board set it too. That provides maximum flexibility for changing our number of board directors. But the bylaws can set that. It talks about the power of the directors, their term, et cetera, et cetera. So the meeting stuff is something you should look at before we come back next week. Take a look at the meetings. We're going to talk about the meeting rule, so take a look at section 21 regarding meetings. Basically what this is doing is capturing the fundamentals of the Delaware law. So I'm not saying you can, in practice, blindly trust documents generated by Cooley or whatever. But I am telling you that I've looked at this one, and I believe that this accords with Delaware law. And at least for our present purposes, you can get an approximation of what Delaware law requires by looking at this, as opposed to going back to the primary source. This should, and for the most part, I think does accord with Delaware law. But again, cautionary note, in practice, you have that obligation to confirm. And Delaware law changes. Right? The documents, Delaware law changes, and you have to keep up with it. Here's concepts about quorum, about voting, right? And again, the idea is that the number of directors that constitutes a quorum is set in the bylaws. The default is half. Here it sets it to 1/3. You can do that, right? So you have to know a couple things. You have to know how much flexibility there is in Delaware law to set things less than a minimum. What are default laws? What are mandatory laws? But really, fundamentally, if you're ascertaining if a meeting was done properly, you have to read the bylaws. You cannot tell anything about corporate governance if you don't look at the bylaws, because this is where it sets the rules. This is the rules of how this company functions. Was it done properly? I don't know. Check the bylaws. So committees, yada, yada. This is going to be relevant. This section here about officers, sort of duties of the officers, is going to be relevant because this is a grant of authority. This is what the officers are entitled to do. This is, again, an express grant of authority. That'll make more sense after you read and we talk about Chapter 8, so we'll come back to it. Issuing stock, dividends, indemnification. Okay. In the interest of time, I want to show you just one last thing before we break, which is that stock certificate. Because there is that question about transferability. So if you're buying a stock from somebody, by the way, they're usually printed on like pretty paper and like hard card stock, and they have kind of the corporate logo and stuff. But really, all they have to do, in fact, you don't actually need stock certificates. You can have uncertificated stock. It's called by book entry, and just keep it in an Excel document. Fine. But here's what I want you to recognize is that on the back of the share certificate, we're going to have those transfer restrictions. And so if you're buying stock and it says these shares are subject to restrictions in the bylaws, you should get approval from the company. And so that should make it harder to fudge this. And if someone is like forging things, that's obviously, we have laws against, forgery and bad action, things like that. And if this is hard to read from where you're at, we can just zoom that in a little bit. These shares are not registered, and so they can't be publicly sold. That's a securities law issue. Not going to worry about it. These shares are subject to a right of first refusal, as stated in the bylaws. If you're curious about that, take a look at the bylaws and find the right of first refusal, and they're subject to a transfer restriction. And so we can actually just...
And if you're just a buyer, would you be able to see the company's bylaws?
You should ask for them. If you're buying stock in a company and they refuse to share with you the bylaws, you should probably not buy stock in that company, right? That's a huge red flag. Why are they not providing that information? What's wrong with that company? Why would you not provide the bylaws? Only because something really naughty is going on, right? So, yeah. So here's that right of first refusal. So if you read the bylaws, you could find this pretty easily. Again, a lot of corporate law involves Control F. You'd have to know what words you're looking for and what concepts you're looking for, but here we have that right of first refusal, and this discusses the details, the mechanics of how that works. So if you're confused still about what a right of first refusal means, just read the mechanics. It's all right here. We'll talk about it more in the next coming weeks, and then that's one type of transfer restriction. And usually they should be named, yeah. Transfer restriction, right? Again, pops up here, and it should be readily identifiable and explain the mechanics of how that all works. All right, so we're out of time, but as a summary for what we learned today, it's relatively easy to generate the documents in a company just from a matter of answering forms, but it can be hard to know what to put in those, and there's a lot of little considerations. How many shares of stock to issue, what to set the par value. It does take a little bit of learning. But at least now you know how to do it, and what you'll be expected to know is sort of what were those basic steps, and then what gets filed. The first thing gets filed, the certificate of incorporation. Next, the incorporator steps aside, appoints the directors, and then, really important, those organizational resolutions. That's Chapter 7. Chapter 8, moving forward, is going to be the bylaws. How do you authorize the company? The bylaws are your first grant of authority. They grant authority in an express way. They say you can do this executive, you can do this director, you can do this secretary. And so look at that as we move into Chapter 8, and then we'll talk about also meetings, and meetings are contained in the bylaws. So look at the organizational resolutions and these documents to reflect back on Chapter 7, and look at the bylaws, and moving forward to think about authorization as we move into Chapter 8. And we will conclude with Chapter 8 after about 3 weeks of covering it, and then review. Any questions?